Hello everyone. Today I will present the topic recording labor cost and sale income. This topic is very important in accounting because it helps companies understand how much they spend on workers, how much money they earn from sales. Accurate recording helps businesses control cost, increase profit and make better decisions. Now let's look at a common problem many companies face when recording labor costs. The hidden problem in labor cost recording. Many companies experience serious problems because of inaccurate labor cost records. Research shows that 38% of large companies are affected by labor cost recording mistakes, losing an average of $2.4 billion per company. In one example, XYZ was fined $150 million for incorrectly reporting overtime labor cost. These examples show that poor accounting system can cause serious financial and legal problems. Because of these risks, accurate labor cost recording is extremely important. Why accurate recording is important? Accurate labor cost recording is important for three reasons. First, regulatory compliance. Companies must follow government regulations. Failure to do so can lead to large penalties. Second, accounting standards. Accounting standards such as IFRS require companies to record labor cost accurately. Third, internal control. Many companies review labor cost monthly. If there is a difference greater than 5%, management investigate the issue. These controls help companies prevent financial mistakes. Next, let's look at how labor costs are actually recorded. Labor costs recording process. The process of recording labor costs usually includes four steps: capturing employees' working time, preparing payroll journal entries, assigning labor costs to job or departments, reporting these costs in financial statements. Each step is important because error can affect the entire accounting system. Let's begin with the first step: capturing employee time. The first step is capturing employee working hours. Many companies use biometric systems such as fingerprint scanners. These systems record employee clock in and clock out times with about 99.8% accuracy. Some companies also use mobile application connected to ERP systems, which automatically record working hours and reduce manual data entry. Once working hours are recording, the next step is payroll processing. Payroll and journal entries. After recording working hours, the payroll department calculates employees' wages. For example, an uh, employee may work 1720 hours in a quarter. The accounting department records payroll using journal entries. Debit work in process for direct labor, debit factory overhead for indirect labor, and credit will be payroll payable. This process ensures labor costs are recorded correctly in the accounting system. After payroll is recorded, labor costs must be assigned to specific projects. Assigning labor costs to projects, companies allocate labor costs to particular job or projects. For example, if a worker spends 320 hours on a job and the labor rate is $28.45 per hour, the labor cost will be $9104. This helps companies understand the true cost of each project. Manager also perform monthly reconciliations to detect unusual cost differences. Now let's understand the difference between direct and indirect labor. Direct labor versus indirect labor. Labor costs are divided into two categories. Direct labor. Workers directly involved in producing goods or services, for example, include factory workers assembling products. These costs appear in the prime cost section of the cost sheet. Indirect labor employees who support production, such as supervisor, maintenance staff, and quality inspectors. These costs are recorded as factory overhead. This classification helps companies calculate accurate product cost. Now let's move to the second part of this topic, recording sales income. Recording sale income revenue recognition follows accounting standards such as IFRS 15. The process includes several steps. First, the company identifies the contract with the customer. Second, it identifies the performance obligation. Third, revenue is recognized when control of the product transferred to the customer, usually when the product is delivered. Finally, companies estimate possible return and discounts. These steps ensure that revenue is recorded accurately. Once both cost and revenue are recorded, companies can analyze profitability, contribution margin, and decision making. One important measure is the contribution margin. Contribution margins equals sale revenue minus variable labor and material cost. For example, if a project has an 18% contribution margin but the target is 22%, management may investigate the reason. Higher overtime cost may reduce the margin. This analysis helps companies improve efficiency and control cost. Finally, let's look at how, in conclusion, accurate recording of labor cost and sales income help businesses control expenses, follow accounting regulations, and make better business decisions. Thank you.